the aforementioned commodity stocks where resurgent global demand, for one, as COVID faded, COVID impacts faded, and very tight inventories meant exceptional performances from stocks like Woodside, BHP, Incitec. And then we can add in the Russian-Ukrainian issues, which have just greatly exacerbated that already tight supply-side dynamic, leading to very considerable outperformance. And I think just about every market participant does not expect the current commodity price environment to remain as high as it is. But for each day, each week, each month that those commodity prices remain high, it is in effect an upgrade to consensus earnings expectations. And that, of course, delivers subsequent outperformance. So that trade of long value, underweight growth, underweight quality worked right the way through February. Of course, as you mentioned just prior to me coming on, that trade is now starting to work in reverse as rates traders are now pricing in the idea that the Fed will not tighten by 50 basis points in a week and a half's time, and in fact might not even tighten by 25 basis points. And that's putting a little bit of support underneath some of these very expensive secular growth narratives. In our view though, the Fed doesn't really have a choice. Inflation is circa 7.5% in the US. They've stated repeatedly that they believe the best way to achieve full employment, maximal employment, is through price stability. And the Ukrainian-Russian tensions only exacerbate that inflationary pressure. So we think that they will still react, and we will, instead of getting 50, we'll get 25, but that longer term forward path of monetary policy might be a little shallower, might take a little longer, but we'll still see rates rise over time, and that will continue to, we think in the near term, support some of those value names.